Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. U.S. interest rate markets finally seem to be settling down a bit, as are U.K. interest rate markets, despite the fact that U.K. inflation was higher than expected this past week. Remember the week before, I mentioned that I would be watching to see how the market reacted to this piece of data if inflation came in stronger than expected in the UK, which it certainly did. But interestingly, UK yields actually fell, which tells me that the strong inflation theme may be running its course for the time being, though, to be honest, I doubt that's going to remain the truth for long. But what did happen was sterling rallied on the news, showing again that our belief volatility would start to shift from interest rate markets to FX markets here in November appears to be coming to fruition. Indeed, as we look ahead to 2022, this is one of our larger themes for next year, that different central banks reacting to different inflation scenarios with different reaction functions is likely to be a major driver of exchange rates into and throughout next year, contributing to generally a little bit more FX volatility than perhaps we've been used to in the last several months. Speaking of central banks, we've talked a lot about the Bank of England in the last few weeks. So this week, I wanted to bring in Kevin Cummins, our chief US economist, to talk a bit about the US and the Fed. So a bit of potpourri here, Kevin. Well, not this past week. U.S. inflation the week before was quite strong. Tell us how that shifted your outlook for inflation over 2022, i.e., the longer term as we look ahead till next year.
Yeah, well, it's certainly the report was much stronger than expected, including our own forecast. And I think it just increases and jacks up the pressure on the Fed. The Fed has a very optimistic outlook in their forecast for inflation. And I think the longer this persists, we saw supply chain issues persisting, energy costs, wage pressures are building, and of course, the all important heavyweight within the CPI, the rising rents. So I think this certainly puts upward pressure on inflation, in particular heading into next year. The Fed meeting is still a few weeks away. But I think they're, going to have to, and they've started to transition a little bit more focus on the price stability mandate. But we may see, an upward revision to some of their earlier estimates within that dot plot as far as their expectations for inflation next year.
So with that higher inflation profile, are you worried about a faster Fed taper or earlier rate hikes?
Well, it's certainly in the realm of possibilities. I don't think we've seen the worst of it yet. If you look at the core PCE, the Fed's preferred measure, you're running at 3.6%. The Fed has it ending this year at 3.7, and then ending next year at 2.3. So they're, like I said, they're very optimistic about the trajectory of inflation. In our own forecast, we have it ending this year above 4% at 4.1%. And lingering closer to 3% next year. In the next couple of months, base effects will start to push that higher above 4%. We don't have it peaking until February, if you look at the core monthly profile in our forecast, until 4.4 in February. So I think it's going to put increased pressure on the Fed. And I think that, the market's expecting potentially, pulling forward the taper is a reasonable perhaps assumption about the Fed.
Yeah, just from my perspective, if you're talking about 2.3 against a 2% inflation target, okay, that feels like it's in the range. 3% versus a 2% inflation target, given the amount of inflation we've had so far, I think is a really tricky scenario. And just having worked on some of our U.S. rate forecasts for 2022, I couldn't agree more. That I think that your view on that challenging period in Q1 is right, which is why, again, I kind of said earlier, I think the inflation story may be getting a little bit well known in the market right now, but it's probably not going to go away forever. All right, so switching from inflation to growth, is there anything new on that front? We talked so much about inflation, but just quickly, are you still relatively optimistic on the growth side?
Yeah, I still think there's a lot of excess savings. The consumer's in very healthy shape. The labor market's very tight. In fact, the Fed's own forecast for the labor market, in their projections that we got in September, they show the unemployment rate, continuing to move lower through their long run rate. At the same time, they have inflation slowing. So it's a little bit of an odd mix there. in that, I think it just puts, again, it turns the focus on the inflation profile. It's certainly, if you look at the core CPI, which we got last week, as you mentioned at the start, in our forecast, we have that over almost at 5.5% of a peak in February. So, it's not just the PCE, but even more so in the core CPI.
Yeah. So lastly, we're still waiting to find out who the next Fed chair is. It's down to, reappointing Fed Governor Powell or making current Fed Governor Brainerd the nominee. So, but if we take your comments about inflation, particularly, but also growth, in the end, do you think there's going to be a big difference between the two if we end up having, close to 3% inflation throughout the year? Can Brainerd be substantially dovish given the backdrop?
Well, it'll be a more of a challenge for sure. With that sort of backdrop, I don't know if a central banker will feel comfortable with remaining on hold even longer than their typical reaction function given the new framework. So it's going to put pressure on her as well. I don't think there's probably too much of a difference in response to higher inflation if you look at Powell versus Brainerd. But at the margin, I guess she could be a little bit more patient. So, obviously it'll all come down to the data, but I don't see a dramatic difference in response from if it were Brainerd instead of Powell.
All right, great. Thanks, Kevin. I really appreciate your insights this week. As for the week coming up, things that I'm watching is that Fed chair nomination. We were hoping to get that before the US Thanksgiving. US PCE inflation data, which again, as Kevin noted, were expected to be high after the last CPI report. We also get preliminary PMI data from the UK and Europe, so we can see if the supply chain issues continue to be a problem on the manufacturing side. And also note that US has their Thanksgiving holiday, so we will probably have a guest host next week. For those celebrating, have a great time off with family and friends. And for the rest, we'll speak on the other side. Thank you very much.
I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.